Hi, this is Naheed Aroni again, and I'm going to take the session 3 of our Advanced Finance for Business Finance, and it's level 5 course. So today we are going to see the forecasted cash flow or understand the effect of cash flow forecast on decision making, especially the management decision making, and it covers learning outcome 2. And then we are going to see the budget and control, and then how the budget and the corporate objectives and the long-term plans are related on the budgetary techniques can be used to plan and control finance. And also to explain the interlinking the various budgets with the business, and obviously we are going to see how to evaluate the impact of expected cash flow on management decision making. Last session, we have covered how to make a cash budget and how I did one exercise. For this session, we are going to look over different kinds of budgetary techniques, controls and tools, and some examples, and how to evaluate and analyze the budgetary tools and techniques. So, as we recommended last week, one good book, which Biker writes through the balance sheet. You can buy it from the Amazon or any Blackwell shop, because this is additional suggested reading, which is very helpful and very easy to understand, and with some practical examples. You can have this, and then you can understand all of these terms from this book. So, what's budget? And what's the strategy and control? Basically, budget is a very core and heart of the finance, because we are doing finance for business manager. We need to understand what's actually the financial analysis and budget, cash flow. And these things are very important for the finance, to understand the finance. So if we want to know about terminology about the budget. Budget is a short-term business plan, normally expressed in financial terms. It's always make it a short-term, and then it's adding so many budgets, a short-term budget adding focus on the long-term budget. So businesses normally establish their mission and objective, strategy, vision to determine why they are in business. Objectives, definitely the goals and what they want to achieve, whether it is profit maximization or wealth maximization. So that objective is a very longer term, and the objectives are then developed to the more specific in a quantifiable goals. And I think we covered what's the short-term and long-term objectives of a business towards a cash budget, and definitely budget is important to working towards the business objectives, goals, and strategy. There are different kinds of budgets in our terminology: fixed, flexible, incremental, zero budget, based budget, variance analysis, and there are some exceptions. Management, exception, controllable, and non-controllable costs. These are based on the reporting. So normally a fixed budget, if we talk about the fixed budget, the budget is prepared on the basis on the estimated volume of production and estimated volume of sales, if it is fixed. But no plans are made for the event that actual volumes of production and sales may differ from budgeted volumes. So that's the fixed. And normally the flexible budget, we recognize the existence of fixed, variable, and mixed, semi-fixed or semi-variable cost, and it is designed to change as to relate to the actual volumes of production and the sales in a period. So normally to flexible budget, either it's multiply the original budget or fixed budget, actual units, budgeted units, or calculate percentage increase or actually units over the budgeted units, that's the variance, and add the percentage or proportion, or work out the variable cost from the budget and apply that to the flexed budget volume. So we will do one exercise, see in the later of this session, that how to flexible budget based on the variance analysis to fix with the fixed budget. And these are some terminology we are going to use in this session. So let's move on the next slide. So how we prepare the budget. Budget preparation is definitely the key function of the budget and needs to coordinate with the different activities. In the big company, there are a budget, and they need to be coordinated with different committee and the budget manual. And the budget manual will state who is responsible. Definitely there's a budget manager, budget director, budget coordinator, supervisor for preparing functional budgets and the timetable for the completion. So always a good budget is characterized by the following criteria. Definitely participation of the all different departments and employees involved, as many people as possible in drawing up a budget that they can understand the organizational objectives, goals, and strategy. There is a comprehensive of everything is well set and well described, embrace the whole organization. There is a definitely standard. The budget should not go on the fairy tale based on the very flaws. Standards should be maintained based on established standards of performance, and there is a flexibility allow for changing circumstances. Definitely in the business there is always unavoidable circumstances, so that flexibility should be accommodated in the budget. There is a feedback from the top to bottom or bottom to top, constantly monitor the performance, and there is an analysis of cost and revenue all the time, because it's very important, which can be done on the basis of products line, departments line, management, or cost centers. If it is coordinated, the analysis of cost and revenues in every quarterly, monthly, weekly, half-yearly, and yearly, this can be done on the basis of different aspects of product, sales, cost centers that will focus a good characteristics of a budget. Definitely there are budget in charge, a budget director, a budget coordinator in the business. At the appropriate time, it is normal for a budget coordinator will distribute all the types of forms to complete the preparation of the budget, forecasting the budget, additional adjustment of the budget together with information about the key assumption. Typically, the budget coordinator is a senior member of the team or the management team. Normally, the senior person of any business or the experience and skill personnel would be the budget coordinator or budget manager. Nominal style may be different, top-down or bottom-up. Top-down is from the higher hierarchy, from the lower hierarchy, that's the top-down, and bottom-up is from the bottom. The information goes up to the top. So that can be two-way. The budget style can be maintained. Bottom-up budgets allow staff to participate in setting their own business and are set to improve motivation and the quality of the plans. And the disadvantage with participative budgets, if it is bottom-up, is that they can take a long time to agree, because there is always an agreement and disagreement in the budgetary system. So effective budgetary control, if we say about effectiveness and efficiency of the budgetary control, the system must be taken seriously. For example, is there any variance? The variance report are acted upon, is to be taken seriously, and action to be taken very seriously. There must be clear areas of responsibilities of whose work is done and who is the responsible for which areas. And if there is a challenging target, that should be doable or achievable, that should be clear-cut understanding within the team. Research, data collection, analysis, and reporting must be regular and reliable and timely basis. The reporting period should be short, not for more than a month, because it's more than a month, it will give more complications to achieve the business objective. Reports should be relevant to the manager receiving them, and control action must be taken as necessary when it's possible. So these are the quite few aspects of the effective and efficiency to control the budget. So there are some behavioral aspects. Unrealistic targets tend to have an adverse or opposite effect on manager performance. It's lower down the managerial aspects. And if managers participate in setting budgets, they are more motivated to achieve them, and challenging targets appear to get the best results. So definitely there is a kind of a behavioral involvement relates with the budget and the budgetary control and techniques. And then there is a question that is beyond budgeting. There are those who argue that adverse behavioral aspects of budgeting negate or negotiation its value as a control tool. And it is true that it's a vast majority of the organization and companies still use the budgeting to help manage their business. Definitely, it's the core of the business, at the heart of the business. Without budgeting, it can't, or any business can focus to their objectives or strategy. The beyond budgeting movement suggests that organizational goals should be based on the external benchmarks, range of performance indicators, and the continuous planning and annual plans. Now, there is some kind of arguments and disagreement between budgeting and the beyond budgeting. So if you have, if you can do some critical thinking on it, it will be helpful for you. So let's see how can a budget plan go or a process. What should be the effective budget planning process? First, because we are on the cash budget and cash flows, any planning budget, we need to identify the objectives of the business. If it is cash budget, cash flow, we need to identify what should be the inflow and outflow, and the maximum tolerance level of the inflow and outflow. So first we have to identify the business objectives, whether there is a high percentage of profit or the break-even. So identify business objectives. So first, set the business objective. We need to consider different types of options to go this different types of business objectives. So whether it is increase the production, lowering the cost, or increase the labors. So we need to see the different types of options within the business. So consider options, and then we need to evaluate the options and make an analysis of this and make a selection. So identify the business objectives. That's the one, and then we need to consider different types of options and make the evaluation and selection. And then we need to prepare long-term plans, and then which is coordinated with the budget. And then with the long-term budget, we need to prepare different short-term budget with different departments. So this is the actually overall the budget plan. One manager can follow, or the business efficient person can follow this way. And then, as we can see, there's a different issues which need to be considered by the managers or the owner of the business. Definitely the goal, and then we are planning to achieve that goal, the direction, and the other way. So what are those issues for consideration to achieve the proper budget and to achieve the exact business objective? So method of achievement, we need to identify what kind of method of achievement, and then we need to identify the resource to achieve that objective. We need to look over the human resources and human implication of that achievement, and the profit planning, whether it is acceptable or deniable. So these are the different kinds of tools and techniques with issues for consideration to make an effective budget and to achieve and direct to achieving that goal and budget. And then last one of this, so controlling the outcome of the profit and everything, we need to reconsider, rethink, and control all of these aspects of issues for consideration, the need for a goal and the plan directed to achieving that goal. Let's see one example of the budgetary control. For example, we need to go one island, and there is a treasure island, and there is a lots of minerals, precious minerals are there. So we need to make a budget or budgetary plan how to reach that destination. That's our business objective. So we buy a ship, and then we need to make a plan how the route to achieve that destination. Because that's a treasure island, so we buy a ship, and this is our route to simple route, and we fix a route to reach that destination. So when we start our journey, in the middle of the journey, we faced pirates in the ocean, and then we changed our direction to reach that direction. We change the route to reach that direction, so we divert our direction to reach that route. Then, in the middle of the journey, we seen one natural disaster, and again we need to change our direction in the other way. And then again we fallen with underneath shark or a big whale, which is harmful for the ship, and then again we change our direction. So as we can see, this is our actual route or budget, but for the different problems we need to change our direction to reach that point. So in the budget we need to consider the different options and how to achieve to reach that direction. So we see to make one film, for example Gladiator, we need to check the objective, whether we surrender or destroy. We have to plan an alternative plan to obtain that objective. If it is unplanned events like natural disaster and unavoidable circumstances, we need to check and divert the plan on the emergency basis. And we need to reconsider again, have to be very careful about the resources of management, leadership, soldiers, equipments, consumables, money to pay, and everything. And definitely we need to monitor how the battle is going, because always, unless we achieve that destination, there is a battle and there is a natural unavoidable situation may occur in the middle of the journey. Definitely that's an environmental effect, and then cost of lost man and equipment is one of the very crucial aspects of the journey. So as a business, always focus for the need for profit, so to satisfy the business and its shareholders to increase the share values. And the stock market, so we need to raise money for the return on capital employed, and this ratio we'll discuss more about when we have the financial statements analysis session. And then we need to have a fund expansion to fund inflation. We need for profit, we need to make our profit maximization. Now, there is a situation, if we think about the budgetary process for manufacturing company, what if we are a manufacturing company of global high demand and with innovative technology such as a new computer games console, would that start with a sales budget? So there are the different kinds of budgets we need to consider for this particular manufacturer company. Sales budget, which is broken down by product group and the geographical area, and the decision are taken on a new products and whether to drop or old products. Production budget, to achieve the stock levels, we need to work out the required monthly production. And then we need to see materials, labor, and the other budget, which means these elements of production all need their own budgets once the production requirements are set. Now, that's a cash budget we did last week, but on the basis of this budget, we need to prepare the cash budget and the financial that ties in all other budgets together to show the total cash requirements for the period ahead. So that's a cash budget, and then we need a summary budget of all the breaks down the budgets across the time periods, division, and subsidiaries, etc. Master budget, this is the one finally adopted when the senior management have adjusted the budget according to what they need to satisfy the investors and other interested parties in the company. And there is a report for responsibilities. The budget is then dispersed to the relevant senior staff whose job it is to control that budget. So not only the cash budget is impacted, but all the other budgets and departments that's associated with the cash budget. So budget is one of the very important tools and techniques for the process for any kind of manufacturing and other services. So we need to coordinate and discuss and reconcile all the departments and other budgetary departments and managers to make an effective budget. Now, in practice, for example, we have a budget and a normal budget, which is forecast budget, if you say the cash forecasted budget, and we have, in the practice, there is the actual budget. For example, in the company, there is the electricity consumption. The budgeted amount is 23,500, but in actual, it has been consumed 27,200. That means the company made a budget on 23,500 electricity consumption, but in actual, it has been consumed 27,200 in electricity bill. That means 3,700 pounds are over in the electricity budget. So this is called the adverse. Normally, if there is any cost item which has exceeded the budget, any cost which has exceeded the budget, so that's adversely affects. But if any revenue item, for example, sales or profit, that would be shown with the bracket favorable. Any income budget, any profit budget, any revenue budget, if it is increased, that's the favorable. So that means if anything increase in the cost item, that is adverse budget variance, and if it is increase in the revenue, income or sales, and if it is increased, that will be the favorable budget, and vice versa. So let's take an example on how we can see the variance from budget and actual budget. So for example, if the company sales is 21,000 and actual is 25,600, and the difference between the sales from actual to budgeted is 46,100. That's 4,600. That means sales has been increased. If it is increased, that is favorable. That's the favorable. If it is any kind of cost, like materials, labor, or overhead, and it's a increase or decrease, that is an adverse. If it is increased, that's adverse because it increased from 1,400 to 1,700 to 220, because it's a cost. So that's adverse variance. That's adverse. And if it is this overhead reduced from last budget, actual budget, actual budget from the original budget, that is 360 unit, that's the favorable. So any cost item, if it is reduced, that's the favorable, and if it is increased, that's the adverse. So as we can see, the fixed overhead has been increased, so that's the adverse, and the profit has been increased, that's the favorable. The sales profit, if it is increased, that's the favorable, and if it is decreased, that's the adverse. So let's take one example, fixed budget. As we can see, the fixed budget is a budget which is prepared on the basis of an estimated value and volume of production and estimated volume of sales. But no plans are made for the event that actual volumes of production and sales may differ from budgeted volumes. So we have a budgeted sales 45,000 and budgeted cost 38,000, but in actuals, we have 43,500 actual sales, which is decreased, definitely the adverse, and the cost has been decreased, that's the favorable. So let's see the variance. That's the original budget and the cost. So profit is 7,000 pounds. In actual, let's see. So profit has been increased, that's a favorable. Cost decreased, favorable. But the sales decreased, that's adverse. So that's adverse, favorable, and that's the unit of amount, adverse and favorable. That means from the decision making, if you see this kind of variance, and if for the decision make, although the sales have fallen, 1,500 units, the costs have fallen by more, producing a favorable effect on profit. So sales fallen, costs reduced, and the effects on profit is favorable. So this kind of variance analysis should be considered when the manager are considering their budget and other terms. A relationship between actual profit and the budgeted profit. So budget profit is estimated profit, so forecasted profit, the manager are expecting the profit for the forthcoming period of time. So when we add favorable variance with the budgeted profit, and then we minus the all adverse variances from budgeted profit and favorable variances, that equals actual profit. So we need to calculate all favorable variance, that's plus with the profit, and then we minus all types of adverse variances. That will give us actual profit. So in our budgeted profit, so we need an actual profit. So we need to identify the favorable variances and the adverse variances and favorable variances. As we said before, that all kind of cost, if it is increased, that's adverse, and all kind of sales, revenue, income, and profit, if it is increased, that favors the business, that's a favorable variance. If it is decreased, that's adverse variance. So profit, sales, income, and overheads and other costs could be favorable or adverse. So all favorable variance would be added with the profit, and all adverse variance will be deducted or will deduct from the favorable variances. That will give us the actual profit. So let's have a look one good example. So this is one fixed budget operating statement we have seen. These are the adverse variances, and these are our favorable variances. So when we add the favorable variances with actual profit, with the budgeted figure, and then we minus the adverse variables, and we will get the actual profit. So from the budget, we can estimate our cash budget, and we can see how it impact on cash flow forecast on our decision making, whether we reduce our overhead costs, we reduce our materials and labor charge, we can increase or decrease our sales. It depends on our forecasting and variance analysis. Now, control system is one of the very important aspects of the business. So as we can understand, there is an actual and budgeted figure, and then we have a variance of different heads. How could you control this system? Definitely, the control system means the objective, plan, and action and measure. So we have a sales, higher sales, that's the objective, and then we can make a plan considering different options, and then we go for the action, and then we measure the very different kinds of variances. Now, this is the important aspects. Now we compare with the actual and budgeted figure, and then we rectify it, correct it, and then again we remeasure it, and this is a cycle. We can go for on it. That's a control system. Before we compare and correct it, we need to make objective, plan, action, and measure. This is the whole control system. So objective, plan, action, and measure, that we set all the actual and budgeted figure, and then we made the compare and correct in the controlling system. So this is needed for every business for cash flow forecast on decision making, and then we can understand the impact of expected cash flow on the management decision making. So that's actually our main understanding, how we can understand the actual impact of cash flow forecast on decision making. So why it's necessary? Why we need a budgetary control system in our business? Because it motivates staff. Because if they understand what's actual and the variants are happening in the business, then it can motivate the staff. It can coordinate the different departments, products, sales, and then budget, the main department, and there is a different cost centers. There will be effective communication if they do the good budgetary control system and by the coordinating between the different staff. There's a delegation of authority. There should be a prioritized section, so which section, which overheads need to be prioritized, and then management can allocate their different resources to different departments, and then it will be helpful in the decision making, which is our key aspect to understand the impact of cash flow forecast on the management decision making. So main key is involvement of staff in the benefits of budgetary control systems. So that's the aspects of the budgetary control, but there is always a criticize, because it always involves the cost, because you can't avoid the natural disaster and unavoidable situation in the business. It's inflexible, and there's a limitation of initiatives. There's a defense mechanism, sometimes can be understand or can be defined what's the defensive mechanism can follow the business. There is a need to create a expenditure for the, as we can see one example, that we need to go one destination over the ocean. So there is a different kind of unavoidable situation middle of the journey, like pirates, natural disaster, and there is under a shark and the big animal underneath the ocean. So that's the one thing it can't estimate before. So key involvement is efficiency and training. So the more you train, the more you understand, the more you practice, they can they can control good budget, and then they can make a procedure for the good control system in the budget. So now, if you go for the flexible budget, we talked about the fixed budget, and then we compare the fixed budget with the actual budget. Now we flexing the budget, because the variable cost will automatically increase if the volume of activity increases, and the vice versa. And if you compare the cost of production based on the previous unit, when the actual units produced are more than that or less than that, what will happen? Because in the fixed budget, we compare the actual and budgeted figure. So when the volume of output or sales is different from the budgeted, and the budget is often flexed to reflect the actual volume, flexible to reflect the actual volume of activity. So flexible budget give a more valid comparison between the flexible budget and the actual result. So let's see. So for example, we have seen a budgeted figure, and then we've seen the actual budget, and then the variance. So 3 columns we've seen. If we add one more column in our budgetary control, for example, the flexible budget, then how it relate with the variance analysis. So let's see. We done before original budget and the flex budget and our variance. Now we done original budget, and actual and variance. Now we add one column, flex budget. For example, our original budget is 14,000 and actual was 16,000. But we limit one budget in some units in terms of sales and materials and everything. So some figures are here. Then we make the variance. So with the flex budget and the actual budget, we make some adverse and the favorable variances here. So for example, the flex budget is 24,000 sales, and then actual is 25,600, and then we have found the favorable variances here, and then these are the difference between these 2 columns, flex budget and actual budget, and which just came from the actual and favorable variances in terms of the actual and flexible, not the original. Now, how can we calculate the budget, flex budget, for the following costs? For example, we have a fixed budgeted units 1800 and budgeted variable cost 25,000 and actual units. Basically, it's a flexible budget based on the semi-variable, variable, and fixed cost. So when we change that unit, how it affects on the actual and the flex budget. So, and then another example is we have a unit, and then we have a semi-variable cost, and then we have a per unit cost, and what will be the actual unit cost. Okay, let's see how we will calculate this one. So fixed budget, because we have a, we need to calculate the fixed budget. So budgeted variables is 24,000 and actual units is 16,200 divided by 22,500. I think it's that's our flex budget. And then because it's divided by, I think, budgeted 18,000 budgeted units. So budgeted variables times actual units divided by budgeted units. That will come to 22,500. And our original budget is here, variable cost and fixed cost, which is 1,500 and 25,000, which is 4,000. And then we estimate our flex budget here, per unit cost, and we add the per unit cost with our original budget, and that will be our flex budget, 4,300. So that's the activity we can do with calculate the flex budget for the cost. Now, flex budget, if we take one example here, like sales, variable cost, and fixed cost, and then that's a per unit cost for the sales, and in the actuals, that's the budgeted, and in actual it was a 0.95 pence. So 95 pence was the per unit cost, and the budgeted figure is £1 per unit cost. Now let's see what will be our variance based on the flexible budget and actual budget. In the original budget, we have a 5,000 profit, and we have a sales and units because it's £1 per unit, and then we have a flexible budget. These are our profit, 7,000. In actual, we have 41,800, which is reduced, and costs are reduced as well, and profit is always reduced as adverse. And now our costs are favorable, profit is adverse, and sales is adverse. So sales adverse, profit adverse, and fixed costs increase from the flexible budget to actual as 500 increase as adverse. Only the variable cost is favorable. So units have increased, the sales, all the value have increased by a smaller proportion because of the price discounting. Because we discount the price 5 pence from 1 unit, and the variable have increased, but by the lesser proportion of fixed costs have increased, producing an adverse effect on profit. So it depends, if you flex the budget from the original budget, how your profit will be affected and how your cost will be affected. So that's the one important aspect on decision making. You need to make adjustment with your cash flow to set the target or objective of the sales and the other profits. Now, all of these techniques and tools can help managers to make to prepare effective budget. So how budgets help the business managers? Budgets tend to promote forward thinking, forecasting, and the possible identification of short-term problems. If the manager can identify the short-term problems, they can identify the solution, and then that will be helpful for the long-term budget. Budget can provide a system of authorization for managers to spend up the particular limit. So budget can set a tolerance level, budget can set a limit to spend the highest amount of expenditure and the highest amount of revenue to cover the expense. Budget can motivate managers to better performance. The more the profits the manager gets, the more they are motivated for the performance, and that will be the trigger to motivate and instigate the employee to do better performance. Budget can help coordinate various sections of the business. Budgets can provide a basis for control. So budgets, if you forecast and make the manual of the budget, that will always provide a basis for control mechanism of the business, finance, production costs, sales, revenue, and everything. There is always a zero-based budgeting. Traditionally, many budgets prepared by looking at that what's happened this year and then adjusting the number for any perceived arrests like changes in inflation. So that could be happen and then adjustable, and that's a zero-based budgeting. And zero-based budgeting rests on the philosophy that all spending must be justified. The assumptions are that will be no spending and a budget will only be made if a specific case is made for the expenditure. So that zero-based budgeting means there should be an unavoidable situation that should be considered, but that only occurred when the situation occurred. In the previous actual flex budget, we limit some variances and then we set some tolerance level. So in the zero base, that's the opposite. Only the actual occurrence can be compensated with the original budget. So zero-based systems has been operations for some time. There is a tendency for next year's budget to be justified by reference to the actual levels being achieved at present. Even using such an analytical base, some business find that historical comparisons and particularly the current level of constraints and resources can inhibit really innovative changes in budget. So it's kind of innovation budgeting. So if we adjust the zero-based budgeting in the system, and this can cause a severe handicap for the business. Sometimes that's a limitation because the budget should be the first year of the long-range plan. Thus, if changes are not started in the budget period, it will be difficult for the business to make the progress necessary to achieve longer-term objectives. So these are the zero-based budgeting that one manager can look over, and then there is obviously limiting the key factor of the budgeting. There's always something that limits the business activities. Usually, it is the ability to sell this product, but it can be some capacity of shortages, like budget cannot forecast labor unrest and problems, the capacity of the production, the machineries, or skill level, or other things related with the machinery. It is normal to budget for the limiting the factor first, as this will normally constrain the other activities and influence their budgets. So now we have seen the different types of variances in our experiences and the examples. So we have different kinds of budget: fixed, flexible, and these our budgeted. And then we have seen the actual. And now we have seen the variances. Now we are setting a tolerances. So if we set a tolerance of variance, that will very good control to set the business objectives, because the tolerance is a preset tolerance that may be created in absolute terms of percentages. The purpose is to create the exception reports that dictate management action, as where otherwise managers can find it hard to determine which variance need action. For example, we have a budgeted figure thousands unit, and we have actual figure in the 1,100, 500 units in our monthly gas bill, and we have seen that's the exceed of 150 unit. That's 50% over. That is 50% extra from our original budgeted figure. If we set a tolerance for this variance, plus 12% or minus 12%, then we can accept this variances. And if it exceeds this tolerance level, then we will go for the action. So we'll take the necessary action. That means the variance we will calculate by percentage, which is compared with the tolerance allowed if outside, as here the management can take the action as it's required. So here our tolerance level is 12%, but our variance percentage is 15% plus. That means management needs to take the action because it's over on the bill or the unit. So the tolerance level is 12%, and then here variance level is 15%. So management needs to take the action. So setting a tolerance in the cash budget or any kind of budget is a good way to control control the budgetary procedure. So if you see this review of the budget or flexible budget, so this is our original unit and an original budget, and we have our output in terms of unit, and then we have a sales, direct materials, direct labor, different kinds of overhead, that's the variable cost, fixed cost, and the profit. Now we have a flexible budget and we have a actual budget. And this is a variance. And this variance is, if we convert it in the percentage, I think it's a 10% or 10% of the 24,000, 10 or I think it's 15% if we calculate variance of this unit in terms of weight. So if we set the tolerance here, then we will take the adverse or favorable, and then we will take the action required. So these are the most important thing. When we set the tolerance level of the variance, if you set the tolerance level of variance, then we can control the budget and the other things to to achieve our business objective. So here we have in this session, normally we are trying to understand the impact of cash budget on in any kind of budget on management decision making, how management can take the control, or how management monitor the different kinds of budget, and how can management fix the flexible and fixed budget, and on the basis of the variance analysis, how management can make the decision making on the basis of tolerance level. And there is obviously the management actions are required in terms of tolerance. So far we have covered cash flow, budget, and for the first session we have covered the costing techniques and the marginal costing. In next two sessions we will cover the financial implications and the financial performance. We need to produce a handbook for the assignments which covers 4 different tasks: cash flow, one task; costing, marginal costing, the one task; cash budget, marginal costing, capital investment decision, and the assessing financial performance and stability. So if you need any question, if you ask any question regarding the assignments and the session understanding, please feel free to email me. I'm Ronnie, and I'm ready to pick up your email anytime. This is my email address, drronnie@versity.co.uk, and then you can email anything to me regarding these courses, Advanced Finance for Business Managers. Also, there is a Moodle area, and there's everything in this Moodle area, including this session recording. You can hear the sessions of every sessions with the PowerPoint slides, and then there is a brief discussion of the assignments on the second session. So you need to submit your assignment within the end of next month, and we will start our first drafting of our handbook regarding the costing, cash flow, and capital investment and analysis of the performance of the financial stability. So if you email me regarding any query, then I will reply you promptly, and I hope for divorce to see you in the next session. Thank you.